Good morning, everybody. Welcome to Windsor Brokers Live Daily Market Outlook for Thursday, 24th of January 2012. Quite important day according to the economic indicators that are due to be released today or already been released, with a series of PMIs to give us a more clear picture of whether the world economy is on the right path and moving towards recovery, or we are still in the dark and the recovery is still far away. According to the Chinese data PMI, manufacturing PMI that was released earlier during the night, the release was quite positive and optimistic. 51.9 came compared to previous 51.5. That showed that growth in China's factory sector accelerated, reached a two-year high now in January, with the immediate market reaction seen upon release, pushing the riskier assets, bringing basically the risk appetite back in play, as the data provide the encouraging sign for the global economy, as China is the second biggest economy in the world. As a result, the Japanese yen weakened again against US dollar, as the pair hit levels at approximately 89.40 so far, jumping out of a dangerous 88 zone where the temporary support was found. But from the other side, most of majors still remain entrenched within the narrow ranges, as euro holds between 132 approximately 70 and 133.70. Sterling is, euro is in past 10 days basically holding this range. Sterling is in past 3 sessions between 158 and 159, while dollar Swiss struggles to regain, to hold above 93.00 after finding support at 92.70-80 zone. From the other side, the commodities dipped further. We are going to discuss this a bit more. Let's now move just to the other highlights of the day that are already listed on our screen. As said, U.S. debt limit extension passed the House of Representatives yesterday. Plan to allow the federal government to keep borrowing money through mid-May, clearing it for fast enactment after the top Senate Democrat and the White House endorsed it. The vote was 285 against 144 in the Republican-controlled House, through the opposition of 111 Democrats, many of whom labeled it as a negotiating gimmick that would set up a new fiscal cliff weeks after the White House and Congress reached a deal to avert the package of automatic spending cuts and tax hikes. The plan avoids, for the time being, a repeat of the 2011 debt ceiling standoff that rattled markets and prompted the downgrade of the government's AAA credit rating. The U.S. Treasury is expected to exhaust remaining borrowing capacity under the 16.4 trillion US dollars debts limit between mid-February and early March. As from the other side, according to the polls showed from Reuters, the world economy is set for slightly brighter tone in the 2013. Should perform slightly better this year because recovering growth in Asia will gradually overpower the political and economic problems in the West. This is according to the Reuters poll. And the latest survey of more than 600 economists worldwide released yesterday showed global economic growth is likely to hit 3.3% this year, following an unexpected 3.1% growth seen in 2012, a slight cut to forecasts from a poll 3 months ago. The outlook for this year looks to a certain excitement on whether emerging economies such as China and Brazil finally deliver the upturn that many economists had expected in 2012. The main threats to the stability of the world economy lie in Europe and the United States, as they have now familiar ring to them. As we already mentioned about market movements, yen falls again against US dollar. Fresh low is 89.44. while more significant losses were seen on the crude oil and the gold, as crude oil done yesterday, heavy trading dropped for approximately 1.5% after the main pipeline Seaway reduced basically the volume flowing through it, and rising concerns inventories in Midwest delivery point for the contract might swell further. The crude oil lost, as we said, 1.5% on its down move from a fresh high posted yesterday at 96.90, dipping as low as 94.95, basically testing now the 95 psychological support, with the near-term structure as now being negative, as shown on the hourly technicals. From the other side, improved outlook for the world economies that pushed the investors into more riskier assets, and leaving the safe haven instruments had affected the yellow metal, as gold, unable to clear 1700 barrier on several attempts, dipped to 1677, cracking our initial support at 1684. That now might weaken the near-term structure and put the upside targets at 1700 and 1706 temporary on hold. Euro and the euro dollar and the cable, as we said, remain in the range, trading with the trigger seen on the break of either sides of the range, with the narrow range on the euro dollar seen at 91, 92, 70 and 133, 70 and 133, 132, 70 approximately narrower range, and the 132, 55, 134 as a wider range span, break of which is initially the narrower one break of either side to signal the fresh direction, while confirmation requires, of course, break above or below the wider range limits. The most significant releases are European PMI data that might give some more clues into the current outlook, will give us definitely clues of the current outlook of the European economies, and might boost the markets on either side, and to possibly to define the near-term direction. As said, the Chinese HSBC flash manufacturing PMI came at 51.9, better than 51.5 of the previous month, December's release. While more disappointing data so far released came from France, manufacturing PMI for January came in disappointing 42.9 versus 44.6 in December, and a quite optimistic forecast at 44.9, showing that French economy is further contracting. Services PMI came at again lower than previous and expected. 43.6 is today's release versus the December's 45.2 and the 45.6 forecast. Again, disappointing data came from Spain. Unemployment rate in fourth quarter increased to 26% compared to 25% in the third quarter, and 25.2 increase seen as a forecast. Still to come, German Eurozone and the U.S. manufacturing PMI's data. The German ones are due at 8:30 GMT. For January, forecast is 47.1 versus 46 in December for manufacturing, and 52 unchanged for services PMI. Eurozone data are due at 9 o'clock GMT. Services PMI is forecasted 48.1, above the 47.8 previous release, while also the quite optimistic forecast for manufacturing PMI for January at 46.6 versus 46.1 in December. And current account is expected, according to the forecast, to show increase in the trading surplus to 4.2 billion euros in November, compared to 3.9 million euro surplus seen in month of October. From UK, mortgage approvals for December are forecasted slightly above the November's release. That was 33.6 thousand, 34.1 thousand is the forecast. Realized sales are expected to dip in January to 17, according to the forecast, versus 19 in the month of December. And then data come from across the ocean. U.S. Weekly jobless claims due at 13:30 GMT are again expected in the more pessimistic way compared to the last week's surprise drop to 335,000, the last time seen 2 years ago. With today's forecast again back in track at 361,000. That was the initial forecast for a previous week's release. Flash manufacturing PMI from United States is due at 1400 GMT. Some contraction is seen according to the forecast that shows 53.2 consensus versus 54.2 release of the month of December, and the leading index from United States for December due at 1500 GMT shows improvement according to the forecast by 0.4% versus the contraction of -0.2% in the month of November. Natural gas storage is due at 1530 GMT. We have no forecast while they moved they postponed the U.S. Weekly crude oil inventories data that were due to be released yesterday, but due to holiday in the United States on Monday have been postponed for today. Release at 1600 GMT, and the forecast shows build of 2.1 million barrels compared to draw of 1 million barrels on the last week release. And late in the evening, Tokyo's the Japanese CPI data, a national core CPI for December is expected to dip to go down by 0.2% versus -1.1% in the month of November, while Tokyo core CPI for December is expected slightly better than -0.6 in November. -0.5 is the release of is the forecast for today. In monetary policy meetings of the latest Bank of Japan's session are due at 2350 GMT. The previous two CPI data are due at 2330 GMT, and that's basically all from today's news highlights and the fundamentals. We're going to take a look now at our technicals and see what are the expectations for the coming day, starting with the single currency. As always, hourly chart shows the pair within the narrower range as a part of the larger range. We have the range from 14th of January, top 134 and low at 132.55, and then back to the hourly chart we see the narrower range that is on the downside limited at approximately 132.64, and on the upside at 133.70. Total lack of any impulse to push the pair in either side to clear of either barrier keeps the sideways movements fully in play. This morning there was a bounce higher to 133.42, 133.46 basically, and then proved to be short-lived for now. Neutral tone is still seen on both 1 and 4 hour charts, as studies are basically flat at this point. We require, with the narrowing Bollinger Bands showing no action at this moment, we need to see break on the upside the minimum 133.70 as initial barrier in order to attract the upper strong barrier at 134.00, and possibly break of which to possibly trigger fresh extension of the larger uptrend, or conversely loss of 132.64 to open a more significant 132.50 zone, where we have 132.55 low of 16th of January and 38.2% retracement of the uplift from 129.96 to 134.02 to trigger a further reversal. This is basically all from euro, as sideways movements and range trading is still in play, and we have no clear direction at this point, just the levels to watch in case of a break of either side, as single currency has been lately moved only by news and the economic indicators, and this is again going to be the main trigger for today's session, as a number of PMI data comes out. According to the release of French PMIs that came in quite disappointing way, according to the forecast that was very optimistic. If the things, if the European countries follow the model of more disappointing data, then we might see some more pressure on the single currency. Of course, the main focus is now on German and Eurozone PMI data that will give us some more clues about near-term action of both currency pairs. And British pound against US dollar, again, we are entrenched within the range, no direction. At this point, the pair is basically between 158 and 159 range with the rather flat hourly studies showing at this point no direction for the pair. 158 is so far offering a good support as several attempts failed to break lower, but the pair is lacking strength and momentum for any stronger action that will result in a possible stronger recovery, as the latest attempt higher stalled at 158.91. That was yesterday. It marks exactly 38.2% of the latest down leg from 160.38 to 158.01, showing that lack of strength and momentum still keeps the pair within the narrow range, and the subsequent reversal lower still keeps the downside vulnerable, as upside is still firmly intact. We need to see break above 158.90, 159. That is quite a strong resistance. There is also the 200 days moving average at this point, seen as initial trigger for some stronger recovery that will open next levels, 50% retracement at 159.20, and then 61.8 at 159.47, along with the previous low at 159.54. As we mentioned in our this morning's technical outlook, regain of minimum 159.50 would be seen as a spark for some stronger recovery, and would signal base at 158.00. Until then, more range trading, and still more, I would say, more risk towards the downside, as daily structure is still holding negative tone, and the pair basically lost the 200 days moving average and the previous low and range floor, 4-month range floor at 158.26. That still sees more focus towards the downside. The current, according to the current structure of the technicals in the larger and the lower time frames, the negative tone that is still dominating on the 4-hour chart sees that current movements could be described as consolidative and preceding a fresh weakness, with break below 158 required to clear break, and close below 158.00 required to resume the weakness, larger weakness of 163.80 peak, and probably open 157.50 and then 157.00 our next downside targets. As said, only break above 159.50. That is reinforced also by descending 55 days exponential moving average would provide the temporary relief and open way for possible stronger recovery, with another very strong barrier seen at psychological 160.00 level, break of which is to confirm the recovery is underway, and the open way for some stronger corrective action. However, as we said, negative for our chart structure, with the price still holding between below both 20 and 55 days moving average, that are, by the way, both still in descending mode, sees increased downside pressure, and sees more potential towards the downside. Unless we see break of minimum 159.50, then we can say that more focus is still seen at 158.00 support, break of which to signal an end of the consolidative action and the resumption of the larger downtrend from 163.80. From the other side, the dollar yen regained the ground after finding a base support at 88.05. This is just above our strong support at 87.78, higher low of 16th of January, and marks approximately 61.8% retracement of the up leg from 86.81 to 90.23, with subsequent bounce higher, and now improving the hourly structure. Now moved indicators moved into the positive territory, as rally retraced over 61.8% retracement, 61.8% of the down leg from 90.23 to 88.05. Bullish crossovers of 10 and 20 over 55 days exponential moving averages are now underpinning the advance, with the brief consolidation seen this morning under the fresh high at 89.44, with the RSI now approaching the overbought zone that is seen limiting gains for now. On the 4-hour chart, ascending indicators still holding in the negative territory, and basically the further extension higher requires improvement of the 4-hour chart structure. We see the 89, 72, 76 94% is seen as initial requirement to improve the conditions on the 4-hour chart and signal a stronger recovery possible attack at 90.23 with of course regain of 90.00 as psychological barrier to open the recent 2.5-year fresh high at 90.23 for retest and to confirm a higher low at 88.05. That will be signal of end of the corrective action and the possible resumption of the uptrend seen on a break above 90.23. Dollar Swiss is attempting, there's a recovery attempts, mild recovery attempts at this point after finding a base at approximately 92.70-80 zone. These are also the previous lows and approximately 38.2% retracement of the upleg from 91.09 to 93.87, reinforced by sideways moving 55 days exponential moving average. Current bounce higher that broke briefly above 20 days exponential moving average that lies currently at psychological 93 level, sees some potential for some stronger recovery as our indicators are slightly above their midlines. That is a signal for possible further gains with the 38.2 slightly above 38.2% being retraced off down leg from 93.87 to 92.73 being retraced so far. Still congestion is still evident under this level 93, approximately 93.20, break of which and more significant at this point 93.30, 50%, and I would say more significant 93.45, 50, what is 61.8% retracement, and the previous highs required to signal basing attempt base basically at 92.70 and shift focus again towards the upper bound barriers 93.87 and 94.00. that were our initial targets. It's important that the current base at 93.70-80 will hold. That will keep the larger bulls in play. As we can see, the daily structure is still positive as a part of broader rally from 90.77, 90.80 base with a series of higher lows defining basically the uptrend, but again a break above minimum requirement 93.45, 50 to refocus 93.87 and possibly to extend gains towards our next upside targets at 94.00 and the 94.34 currently 200 days moving average. From the downside, not much. 93.00 is now being tested again. Basically break below 92.70-80 is to open way for further retracement of the rally from 91.09 to 93.87 with levels to watch in case of break lower 92.48, 50%, 92.15, 61.8% retracement, and of course psychological 92.00 break of which will completely bring bears in play and confirm the lower top at confirmed top, pardon, at 93.87 in favor of some stronger retracement, probably to stretch down towards 91.00, of course, in case of failure to hold above 92.80. And finally, more interesting movements seen on commodities. Crude oil, as we said, dipped on the reduction of the transport through the pipeline, reversing sharply from 96.90. The price just failed to under our initial 97.00 and psychological target, with the dip so far seen to 94 and 95 zone, where it's also the 55 days exponential moving average. So far it could be still described as corrective, though the hourly studies are in the negative territory and the probability of further slide is quite high, as the price breaks below the moving averages and the slower ones crossed already below the faster ones already crossed below the slower one at 55 days, with 10 days moving average currently capping the upside and the descending 20 and 55 days one 95.71 and 95.93 maintaining the downside pressure. Further extension lower could be seen towards I do apologize for a second. If we make the Fibonacci retracement from 93.54, we are approximately slightly below 50% so far retraced of the recent down move, and then break below these levels 94.82 and then 94.33.61 and the 76.4% retracement. Also the high low at 94.25 with the risk seen on the break below 94 level that would open way for some stronger corrective action of the crude oil price. But overall uptrend is still firmly in play despite quite overbought conditions, as we see the daily RSIs now emerging out of the overbought territory with quite extended MACD also starting slightly to point lower. A signal for some stronger recovery is seen at this point, but again, if we hold above important 94 and the 93.60 levels, then this could be just seen as a brief corrective action as a part of the larger uptrend from 84.05 and the 85.20 that already tested our initial target at 96.79, 76.4% retracement, and keeps focus at 97.82, which is 61.8% Fibonacci retracement of the larger 110.53 to 77.27 descent, and of course the $100 per barrel seen as already seen by many analysts as a near-term target for the crude oil price. And finally, the yellow metal that we said at the beginning, it lost ground on a failure to break. I think it's better seen on the 4-hour chart. Failure to break to regain 1700. Congestion here, I mentioned in our yesterday's comments for the commodities analysis was commodities, the extension of the third wave from 1653 that basically reached 76.4% Fibonacci expansion, slightly above this at 1694, and congestion and failure to break above this level could be a signal of exhaustion of the wave and the possible end. That seems to be confirmed now on the loss of important 1684 previous lows and the Fibonacci expansion 61.8%. That was acting as support now, as the price dipped as low as 1677. More risk now seen towards the downside. Hourly structure is firmly bearish at this point. Some corrective action seen already triggered by oversold hourly conditions, but more significant 4-hour indicators that are breaking below their midlines and now seeing more risk towards the downside. We have quite strong supports at 1673 is the initial one. It's a previous resistance Fibonacci 38.2% expansion, and then 1666 spike low of 17th of January, along with the previous lows at 1664. That could see increased the risk of further retracement and the sideline immediate bulls, as the gold price basically failed to clear psychological and breakpoint level at 1700. So far 23.6, slightly below 23.6 has been retraced, and then as we said 1673, 1670 is the 38.2%, and 1666. If we see the break below 1660, I would say that marks approximately 50%, then bears will be confirmed back in play, and the signal top at 1697, so far the highest seen on 17th of January, while any reversal above 1670 would still keep the overall bullish structure in play and keep hopes for possible fresh stretch towards the upper levels, upper targets at 1694, 95 and 1700 as psychological resistance. And that will be all from my side for today. If there are any questions or comments, please send them now. There is a question about for euro yen. The pair found support at 117 level that marks approximately 50% retracement of the upleg from 113.53 to 120.70, and a quick reversal higher now keeps hopes for a possible fresh extension and a possible extension higher towards pardon, 120 as initial barrier, and then 120.70 as key resistance. Ideally, this is seen as ideal reversal point. I think I mentioned it in yesterday's comments for the crosses. Anything above previous low at 116.45 would be still seen as a good reversal point, and higher low for possible strength higher. That is proved now by bounce to 119 so far, 119.28 seen so far, keeping the upside now in focus as hourly structure now improved and sees more room for a possible stretch higher, as basically the current bounce retraced exactly 61.8% of the latest down move from 120.70 to 117.03. As said, hourly structure is supportive, while 4-hour indicators are still in the negative territory. At this point, we need to see the break above, I would say, 119.80 that marks 76.4% minimum requirement to focus again 120 as previous peak, 120.14, and then 120.70 as the key resistance. Daily structure is in the positive territory, but reversing indicators due to extremely overextended conditions are warning of possible further corrective action that is seen on the daily chart, while 4-hour Ichimoku studies are gaining a positive territory as the pair emerged out of the cloud and currently above, breaking above a Kijun Sen line that is currently at 118.87, giving initial bullish signals supportive for further stretch, while daily Ichimoku studies are firmly bullish as the pair again regained the Tenkan Sen moving average that's currently at 118.58, keeping the bulls firmly in place. So I would say at this point it's more focus is still seen towards the upside. Of course, we need to see the any reversal holding above levels approximately 118.30 in order to keep the current recovery in play. 118.62 seen so far with the bullish crossover of 10 over 55, 10 over 20 and 10 over 55 days exponential moving average is now underpinning the advance, as the recent reversal from high at 119.28 found support at 10 days moving average at 118.60. Any other question, please? Silver. Just to mention, you can find in a number of financial sites our daily technical analysis written ones. For commodities, that includes gold, silver, and crude oil. The current price action is in defensive mode as the pair peaked at 32.46. Initially, gains were struggling to hold above 32.00 with final break higher, seeing it 132.45 and 32.46. However, yesterday's pullback from these levels and a dip as low as 131.84 that lost initial psychological support at 32.00 weakened the near-term structure as our indicators now slid into negative territory, but still above initial static support at 31.80. From the 4-hour chart, as we can see, the price fell short of our next upside target, 32.54. That marks 138.2% Fibonacci expansion of the third wave from 30.46. That is still in play, but of course, break below important 31.80 and the 31.70 levels could be quite risky. With the break below 31.50 that marks previous highs and the 76.8% Fibonacci expansion will signal the completion of the third wave that commenced from 30.14 low of higher low of 17th of November, and would be a signal for stronger recovery. So far, the previous resistance and the 100% Fibonacci expansion at 3188 contained the dips, and ideally reversal here could be seen for a fresh attack attempt higher, and the possible retest of 3245 and then 3254, our initial upside target. Daily structure is maintaining positive tone, though the break above 3245, where the previous high posted yesterday, the price action was capped by 90 days moving average break here. That's also around 61.8% Fibonacci retracement of the down leg from 34.39 to 29.21 would open way for some stronger recovery. As mentioned, levels above 32.54, then we have 33.00 and 33.17, 76.4% Fibonacci retracement. Any other question, please? Oh, we exhausted the questions for today. We'll leave a few seconds if anyone comes. No one is coming. Okay, I would like to thank you all for being with us. We were a bit longer today, quite long. Our next session is tomorrow at the same time at 8:00 GMT. Of course, it's going to be Friday, the last day of the week, and we'll have more results from today's PMI data due across the Europe and the United States that we believe will give some more light and give some more push markets into more action, especially the two majors, euro and sterling, that are currently entrenched within the narrow ranges. So expect to see you back again tomorrow at our same time, at our regular time at 8:00 GMT. Until then, I wish you a nice Thursday, and of course very good and profitable trading. Good luck.